Here in this video, we will go over what happened in our markets today and what Tom Lee just said. Stocks are rallying. It's really a broad-based participation today. The Russell is up over 1%, the Nasdaq up a little bit more than that, the S&P up close to 1%, even the Dow is up over 0.5% today. We did have some data that came out today that came in favorably for markets, and we'll talk about that in just one moment. But look at what Tom Lee just said. I'm actually kind of shocked. Well, let me preference this with, he shared this post. Heisenberg says we are in a raging bull market, but IWM still stuck. My boy Tom Lee says 50% gains on the Russell 2000 this year. You know what to do. Tom Lee reshared this, essentially reaffirming his belief that small caps could still rally 50% this year. I guess in theory, if inflation does continue to fall, the economy does okay, and the Fed can start cutting rates, I believe by July 31st, that could set up a very bullish backdrop for small caps. But take a listen to what Tom Lee just said.
Earnings are still going higher and have room perhaps even to be higher than the consensus right now. Presumably the overall economy is going to be holding up well as well. Where does that leave you with regard to the interplay of inflation, Fed policy, interest rates, and the economy?
Yeah, it's a very tricky alchemy because I think that it's very easy for someone to say, oh, well, inflation, if it's up, it's good for earnings, so if it goes down, it's bad for earnings. Right. And a lot of people got tripped up on that because reality is a lot of companies have inverse correlation to inflation. A great example is technology is inversely correlated to inflation. So their margins actually go up if inflation is falling. And with regard to the Fed, again, you know, the Fed it's tricky because it's unknowable. I mean, I have no insight into what the Fed's going to do. But in general, I think that we've been more optimistic that they're going to achieve their idea of a soft landing. So we've leaned that the Fed is more dovish than people perceive.
You know, we actually have a viewer question right along these lines, which is that, you know, shelter costs, of course, a big part of why reported inflation remains as high as it is. And yet a lot of folks don't want to move because maybe high interest rates are holding them back, or maybe that's reducing the affordability. So in other words, would lower rates potentially help the one thing that's keeping inflation as high as it is?
Yeah, I've heard that argument. Yeah. I think it's actually really well reasoned, and it's counterintuitive because you'd think, oh, well, if you cut rates, shouldn't home prices shoot up? But you're right, if it's liquidity that's keeping homes from moving and, you know, a proper equilibrium of housing, it's absolutely dead on. Yeah. And there's also this excess premium right now on mortgage rates. The 10-year versus mortgage rates is almost 100 basis points wider than it should be. So as soon as the Fed starts cutting, that collapses and it makes housing affordable.
Yeah, like 2.5 percentage points at this point, I guess, right? Yeah. We have to talk about, I guess, the innovation part of this market, which has been a huge source of energy for the upside in stocks. So we have NVIDIA reporting today, really at the center of this massive investment boom. It's also responsible for a big chunk of the upside for the S&P this year. So how do you handicap where we are in this trend and what AI's payoff is ultimately going to look like?
Yeah. You know, to us, when we did a study looking at what drives innovation cycles in America. And believe it or not, the two biggest innovation cycles in the U.S., which was 1948 to 57, which was a boom time, and 1991 to 99, were two periods when the world was short structurally of labor. So you had a prime age workforce growing slower than the total population, which means there was a lot of pressure on either wages or ways to innovate to produce more output. We've gone into a period of structural deficit of prime force labor, which is going to last till 2045, which means another tech cycle, I think, is underway. And for viewers, it's not just like NVIDIA makes chips and you got to buy it. It's just that there may be an 80 million prime age workforce shortage globally. That's $3 trillion of wages that won't be spent on labor. NVIDIA's revenues are $100 billion. So to us, this is really early stages for the amount of money that will be spent on generative AI.
So $3 trillion over, what, 20 years that would otherwise have been spent on labor?
And it's $3 trillion a year.
Oh, it's a year.
So it's actually close to 6% of GDP.
Got it. Okay. And so that, in theory, would be the source of the investment on an ongoing basis on productivity measures.
Yeah, like in simplistic terms, it's taking wage cost to silicon.
Yeah,
is really the theme.
I generally agree with everything that Tom Lee just said in that clip. I think that makes a lot of sense. I think we could be in for a structural bull market for an extended period of time. And I would say another thing that I would add that Tom Lee did not mention is ever since 2020 and really the Rona, millions of retail investors are now investing in markets, actively trying to better their financial future when they were not before. And I think that is another, big pool of buying pressure that we're going to have periodically. It's going to be stronger than other times during periods, in markets that are good or bad, right? Retail tends to follow the trade, whatever direction it's in. But I think that's another big pool of buying pressure for decades. And also the other thing that I would add is the potential risk factor to our markets, I think, is a recession. If the economy does weaken too fast and recession odds do rise, that's going to be negative for stocks. And the data that we got today kind of shows that might be happening. So the data we got today was durable goods orders month over month. Okay, so this is month over month, looking at last month comparing to a new month. So we actually came in at 0.7%. The estimate was negative 0.8%. So if you just look at these numbers, you beat. Economy's strong. Unfortunately, it's not. Last month's durable goods orders was 2.6%. It was revised down to 0.8%. So that's not a strong number. So you were expecting a month over month negative 0.8% because last month was positive 2.6%. So when you're positive 0.7% comparing to last month's 0.8% number, that's not nearly as strong as, what it could have been, right? But when you actually look at durable goods orders excluding defense, that's where things start to get even uglier. So last month, you were at 2.3%. You were revised down to 1.2%. So a big downward revision as well here. You came in at 0% month over month gain. So literally no growth at all in durable goods orders, excluding defense. Estimate was negative 0.3%. Again, that would have actually been a really good number if we did not get the revision lower by like 50%, right? These are massive revisions, and it doesn't look great. This data does not show a strong economy. Now, in this market environment, people like that, right? If the economy is not strong, presumably inflation will not be strong, and that can be good news for the Fed. What really got the markets moving today, especially your small cap stocks, was the Michigan consumer sentiment numbers. So you came in at 69.1, final numbers for May. The last numbers we had was 77.2. So a sharp contraction in consumer sentiment. Consumer expectations came in at 68.8. The estimate was 76, another big contraction there. And Michigan current conditions came in at 69.6. Last number we had for May was 79. So big contractions across the board for consumer expectations, current conditions, and consumer sentiment. What really sent the markets higher was your inflation expectations. So 5-year inflation expectations came in at 3%. The estimate was 3.1%. So you came in lower than what markets were expecting. 1-year inflation expectations came in at 3.3%. The estimate was 3.5%. So finally, inflation expectations came down from the consumer in this Michigan consumer sentiment survey. So what's the consensus from the data today? Consensus is weaker economy, lower inflation expectations. That's a pretty good recipe for stocks to do well, at least today. I don't know how much follow through this will have, because in the grand scope of things, they're not the biggest data points, but this is definitely what helps send markets higher today, which is actually pretty interesting because you're only seeing 10-year treasury yields declining by about 1.6 basis points. CNN's Fear and Greed Index today is neutral at 54. Yesterday, it was neutral at 53. So moving up 1 point overall, you're still kind of greedy on markets, and I imagine, I mean, the overall view by market participants is more greedy than neutral. I mean, the last 2 days have been basically straight up for Nvidia, one of your most risk-on kind of stocks. The percent of stocks above their 50-day moving average today is up 2.63%. So 2.63% of stocks are breaking above their 50-day moving average today. That's a pretty good day for the average stock. And if we look at your latest AI investor sentiment survey that came out on May 22nd, bullish investors were 47.0%, neutral investors were 26.6%, and bearish investors were 26.3%. So for the first time in a long time, you've seen the bears rise, you've seen the bulls rise, but neutral got squeezed on both directions. If we look at the markets on a technical view, the Russell is holding support at its 20-day moving average today. It broke under this for a period in time today, and now you're back above this. As long as you stay above your 20-day moving average, the uptrend is still intact. Technically, I guess you could say the 50-day moving average would confirm the continuation of the uptrend, but the 20-day moving average is even better. This could set you up for a run, potentially as high as the 208 level, even heading into next week. Keep in mind, there's really a lack of catalyst though. So whatever the markets do, it's mainly just going to do it minus any catalyst. If you look at the RSI for IWM, this is the ETF for the Russell 2000, if you guys don't know. It's sitting at 52.1, so it's pretty much neutral. The MACD actually is pretty good, but the MACD line just went under the blue line in the latest 2 days of selling, and that's actually a short-term negative signal. So the fact that we're bouncing back on a negative signal can be a sign of strength as well. The S&P yesterday had a pretty sharp sell-off. You were down over 1% from the pre-market trading. I believe like 1.25% was the round trip top to bottom move yesterday. That was after you hit a new all-time high. So you did get a little bit of rejection around 5,300. On the S&P 500, this is around 530 on the SPY. Now today you're bouncing back up, trading in this range. I want to see, do we go, start into a new round of correction here soon? Because normally, as JP Morgan and others have pointed out, typically you don't get a correction that's straight down and then straight up again. Most corrections you see are down, boom, you bounce, right? And then you fall to a new low, you bounce, you fall to a new low. And you could do that a couple of times. I mean, look at 2022. You fell down here, the January of 2023. You bounced in February. By the end of February, you hit a new low. You bounced by April. And then you came and hit a new low by May. You bounced towards the beginning of June. You hit a new low by the end of June, and then you bounced again, and this one lasted a little bit longer through August as people thought maybe inflation would start to fall and the Fed was going to ease up a little bit, and then you came down and you hit a new low again in October of 2022. Ever since then, you have been in an uptrend, and that's because these sell-offs you would get, you wouldn't hit a new low. You would sell off, bounce, sell off, remain above your prior low, rally again, sell off, remain above. Obviously, you started to create some distance between the lows, and then boom, now you're here back at all-time highs again. The RSI on the S&P is sitting at about 64, which is a lot closer to being overbought, and the MACD looks a lot more bullish as well at 5.33, the signal line at 4.59. So still a positive signal on the MACD, but definitely getting a little stretched on a historical basis. The NASDAQ, really the same thing there. You did get that sharp sell-off yesterday, bouncing back today. Yesterday was a new all-time high for the triple Qs. And same thing really there. You want to watch the 20-day moving average and the 50-day moving average. If you break under those levels, that's not going to be a great sign. The NASDAQ is definitely more extended than the S&P with an RSI at 69.25. So you're pretty much starting to get overbought on the NASDAQ. The MACD still looks beautiful. It looks the best out of any of the major indexes at 6.21, signal line at 4.69. If you are a contrarian, that would say that maybe you're starting to get into stretched territory. Typically, when you do get overbought on the NASDAQ, you do get a couple of days of selling at least to kind of reset the relative strength index, right? To bring back a more neutral stance in our markets after you get super bullish. So I don't think anything is decided here. I think we want to see what happens in the next couple of weeks. It wouldn't surprise me if stocks just trade sideways. Maybe the Russell starts to outperform and catch up on a, RSI relative strength basis to the rest of the indexes. Again, NASDAQ's RSI is at 69, S&P's at 64, the Russell's is at, what, 51? What did we say it was? Pretty close to there. Oh, wrong ticker. The small caps RSI is at 52. So on a relative basis, the Russell has really been underperforming. If there is an area to outperform in the next couple of weeks, I think it is your small caps. Next big catalyst we are going to have is the jobs report, which comes out on the 7th, as well as the next inflation report that comes out on June 11th, the same day as the Fed. We are also going to be entering the 2-week blackout period for the Fed starting next week. This weekend is a longer extended weekend, and you're off for Monday. Happy Memorial Day. Let me know what you guys are doing for your Memorial Day weekend down below in the comment section. But it could just be slow going unless we get some news out of left field for stocks, which usually a lack of bad news is good for stock prices. So let me know what you think about all of this down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day and your weekends. I will see you in the next one.